Welcome to OPCM's 2019 investment webinar series. My name is Justin McNichols, and today I will take you through a 2018 market review. First, to re-educate you about our philosophy and our investment team's goals, we believe philosophically that a disciplined multi-asset class approach where we use individual securities can perform well and as well as a portfolio of global equities, but with taking far less risk. And to us, outperforming in flat to down markets, as you know, is the main ingredient to achieving solid long-term returns. And internally, our investment team really has two goals. The first goal is to match or beat the long-term return of a portfolio of global equities, but to achieve that with a portfolio typically containing less than 60% in global equities. And finally, our second goal is to outperform every global equities market correction on record. Let's review 2018. And 2018 for us was a year of firsts. First, it was the first year on record when no single asset class posted a positive return. Additionally, that meant diversification did not help in 2018. If you looked at a hypothetical portfolio where you simply equally weighted the major asset classes of US equities, foreign equities, natural resources, real estate, alternatives, and fixed income, this was essentially the third worst return in nearly 50 years. What happened in 2018? Well, you had a confluence of indicators moving in directions that we typically don't see at the same time. First, you had pretty rare geopolitical uncertainty with trade wars and tariffs. That caused volatility in markets. Second, at the same time, you had rising short-term interest rates as the Fed was raising interest rates. That became a headwind to both the fixed income and real estate asset classes. At the same time, we did have some inflation rising. That ended up to be a headwind for valuations for a lot of asset classes. Then, toward the middle of the year, there became a fear that earnings growth was peaking. That also became a headwind to PE multiples for US stocks. And finally, a rare instance was the dollar was strengthening as the Federal Reserve was raising interest rates. And a lot of that had to do with the geopolitical uncertainty that I mentioned in the first bullet point. When the dollar strengthens, that can be a headwind to foreign equities and natural resources. So as you can see here, we had different headwinds to each asset class, which is extremely rare. And so for the first time on record, no major asset class posted a positive return, as you can see in the table below, showing a number of different asset classes and sub-asset classes. Well, if you look at what happened in 2018, as I mentioned, short-term interest rates were rising, and that was a headwind to the fixed income asset class. As you can see in this chart, we have the purple line, which is essentially an aggregate US bond index. In addition, in green, you had the federal funds rate target. Now, after a 6-month pause in the middle of 2017 to the end of 2017, you can see the Federal Reserve started to raise the federal funds rate. Almost at that exact moment, you saw aggregate, core, fixed income bonds in the US start to fall. And as you can see in the upper right-hand corner, the correlation between these two was a negative 0.84, meaning as one rose, the other fell. Also, as I mentioned, something that affected multiple asset classes was the strong dollar, which again, it was very rare to see a strong dollar while the Federal Reserve is fairly late in raising interest rates. And here's a great chart to show you what happened in 2018. You had the dollar up 11%, very strong for a year, while at the same time foreign equities were down 20%. And you can see not only did they move in opposite directions, but even many of the little blips throughout the year, when the dollar would occasionally drop, you saw foreign equities rally. And so we had a negative correlation here as well, which hurt foreign equities, even though the earnings growth rates were fairly stable and growing. This caused valuations to drop to pretty extreme levels where we stand today. Now, when we look at multi-asset class investing, it's very interesting to note that the reason this style and discipline is so popular is that longer term, you can achieve equity-like returns by taking far less risk and being far more diverse. And if you look at this table, there are 3 columns of numbers, including a left column with the different major asset classes. If you look toward the middle and examine the column that says since 1977, that's the annual return of each of those asset classes over a 42-year period. And essentially, if you equally weighted each of the asset classes into one portfolio, you were able to achieve a return that's nearly the same as global equities, but you're taking far less risk. However, you can see what's happened just over the last 5 years by looking at the left column. If you simply equally weighted each of these major asset classes, your return was only 1.9% annualized. That is 7.4% less per year for the last 5 years than you would typically see on average. Also, it's interesting to note that each of the asset classes over the last 5 years has underperformed their long-term annual return average. But in the case of asset classes like foreign equities and natural resources, you can see the recent performance over the last 5 years is exceedingly below the long-term average and long-term annual return. This tells us for a number of reasons. When you factor in present valuation, where the dollar is presently, and what the economy looks like going forward, along with the fundamentals, we feel that these are 2 asset classes going forward that should outperform many of the other asset classes. So in conclusion, essentially, this discipline, which has had a relatively difficult time recently, should start to perform more like the multi-decade performance that we see in the middle of this table. Please review our other investment webinar outlooks for 2019, and we look forward to talking to you soon.